Lisa Erickson is the head of public markets group at U.S. Bank Wealth Management. And Lisa, earlier in the show, I don't know if you got a chance to watch, we were talking about oil and crude prices and what that could mean, what the ripple effects could mean for inflation, for the Fed, and even for the stock market. And I guess if we're at the high end of a range, maybe we can deal 86 if it's going back down to 75 or so. But what if it's on its way higher because of supply or because of a strong economy, or maybe because China's not as bad as people think? Does that present a problem for policymakers and for the Fed?
Well, good morning, Joe. And to your point, oil is certainly something we're going to want to keep an eye on. In fact, one of the things we've just been watching overall is what we're calling this last mile of the inflation fight, because we've made really good progress since the second half of 2022. But again, some of that remaining price pressure may be a little bit harder to abate. And then you have items like oil and energy, which again can spike up for various reasons. We certainly have some pressure there simply because Russia and Saudi Arabia have extended their cuts. And to the extent that we get a little bit more of a soft landing, that's going to keep demand up. So certainly that energy price trajectory is something we want to continue to monitor.
Do you think that that was the point we were making, that is becoming the narrative, that the easy work on inflation has been done, and now it's going to get harder and harder? And if the Fed is, definitely set in stone that they're going to go to 2%, then if oil were to stay where it is or go even higher, that's going to be tough to wring the rest of that inflation out, and that could keep the Fed higher for longer, or maybe even go higher than it is right now with rates.
Certainly, the Fed has been really firm in talking about being vigilant in its fight against price pressures. So again, anything that continues to give some concern around whether those will remain elevated and be slower in coming down than the consensus expects is just going to keep them on their current trajectory. And when we look at, again, that last mile of inflation, you have these items like energy that can come in with some spikes just due to various supply demand factors. But you also have, more things that can be less volatile, but just take time to come down. And so, for example, in this last PCE report that we got, we did get some good news that, things were continuing to progress in the way people expected. But when you look at that element called supercore inflation, which the Fed really focuses on, which is essentially core services ex housing, you actually saw that remained a little bit higher at about 50 basis points month over month. So again, we're just going to want to continue to see how those price pressures dissipate over time.
What does this all mean for your forecast for how the S&P does this year for the remainder of the year? And what will 2024 be like?
Well, really in the near term, we are at a more neutral stance on the S&P and the U.S. equity market. And the reason why is you've got really a balance of pros and cons. So on the one hand, we have made some really good progress in the inflation fight. And with the Fed having raised rates so far over the period of the last several months, certainly we're closer to more of a pause and down in the future, even a pivot. And when we look at the economic data, we have seen some green shoots occurring. So when we look at overall economic activity, it has been slowing. But if you look at the trend of that slowing, it's getting less worse over time. So those are all on the positive side of the ledger. However, as we've just been discussing, we're not all the way there in terms of inflation. The last couple of core figures are still meaningfully above where the Fed would expect them. And we have tightening financial liquidity conditions, along with the fact that growth is still slow. So we really feel like the best place for clients to sit right now is just to be at whatever their strategic weight or their long-term typical weight would be in U.S. equities.